Hey everyone, for Market Minutes today, we're going to look at SOFI. This one is a retail darling. Everyone loves it. I remember being very interested in it in the past, so we're going to kind of look to see a little bit about we'll start with, of course, like we always do, we'll look at the financials, then we'll look at the valuation. So this is their latest earnings for Q4 2025. And we can see here that their loan interest income has increased by I don't know, that about 15%. The This other, I guess, increased a little bit too, about 15%. And then now we're getting into their expenses. I think this is like a net. Yeah, okay. So it's kind of different. That's a different kind of model, which makes sense. But yeah, so here's their revenue from interest, expenses from interest, the deposits expense kind of is one that went up a lot. Interesting that the warehouses went down. It's about the same. So the main increase comes from these deposits. And I will say it looks like the gross margin improved slightly here. So that's good. Okay, now they got another source of income here, this non-interest income, which has gone down. Technology about flat. Loan platform fees, wow. That accounts for almost all of the increase in non-interest income. Than other here. So wow. Okay. Total net revenue is this million. Okay, so then that's interesting. So they do net interest right here, and then they're adding the non-interest. So this is in thousands. So this is it's a billion. And so that's a billion. But then non-interest expense really hits them. Look at this. Technology, sales and marketing went up by about 30%. So you'd kind of expect their total net revenue to be going up 30%, which it doesn't look like it did too much. And their net income here, their net income actually went down. Their net income went down from last year. Yeah, why is that? Uh, Um, it must be this income tax benefit that they got from the end of 2022. Okay, so then if you were to not take that into effect, because everything else increased, the expenses, yeah, the revenue went up, and the net interest went up. Yeah, this is kind of a interesting thing. So they are growing. Just that this is weird. This tax benefit. Had this not been there, I know there's all this EBITDA and all this stuff that do this for you, but I just like to kind of go in myself. Yeah, so they had a pretty big increase in net income if you exclude that. That's pretty good. It's pretty good. Um, going from basically 50,000 to 173,000 net income year over year. That's really good. Um, okay. This kind of summarizes it. Net revenue. And then here's this adjusted net income where you can see this. This is a big increase, yeah. And it has it all summarized for you. 184% year over year. That's amazing. It's really good. Adjusted net income, yeah. So yeah. But now the question is, look at the valuation. So this is where it gets tricky because the the numbers look good, but the problem is this PE ratio. This is a very, very richly valued company. So it's fine. It's healthy. It's a good company. It's making money, but people are expecting it. People have put almost $22 billion into this company. And the question comes down to, is that should $22 billion be making more than half a billion every year? Because in the year they made half a billion. And it's taking $22 billion to make half a billion in a year. So that's the real argument here. That's why the earnings looks great, but in my opinion, I think what's going on here is that this valuation is just very high. So it's kind of, is it going to keep growing? So I think the next question really comes down to the sales growth. Does it keep happening? What is the expected 26? I'm sure they said this in the earning, but um, most were too strong, but not hyper growth. So 30% revenue growth. Okay. What about EPS growth? Yeah, which we just saw this. Because we saw their earnings per share, they made 50,000 in net income last year, and this year is 170,000. So this is what I was thinking. Um, yeah, look at this. So this right here is the big one. Right here, cost growing. So improving net margins. So that's the thesis, is that their earnings per share has been growing really fast. It needs to keep growing fast. Their revenue needs to keep growing, and if they keep improving their margins, then maybe the valuation won't be as high. Because this 45 PE ratio, that's pretty high. There's what's the stock? ERT stock. This is one of their competitors. What is the PE ratio of ERT? So this one's a lot lower. Okay, yep, here with SOFI, yeah. You guys aren't here for OPRT. You're here for SOFI. But this is one of their competitors, and I just was pulling this up for to kind of compare the PE ratio. And a low PE ratio isn't always good, because it can be a value trap sometimes. But there's SOFI. If it were me, I think this is a great company. I think they're good, but if it were me, I probably wouldn't buy quite yet. Maybe the charts showing this is a good support. Maybe this is a good time to get in. But I personally would not buy this at these levels. Just because I could come to sorely regret that. But I always try to show kind of both sides. I don't want to try to say, be a bear or a bull. I want to say there's things that are good and things that are bad. And, let you guys decide what you want. So there you